Governments have been spending a lot of money lately, and to do that, they've been borrowing heavily. Some people are sounding the alarm. Others say there's nothing to worry about. So who is right? Well, high-quality sovereign creditors have a useful option that most borrowers don't have. They can just issue new debt to replace the old. That sounds like a nice gig. But there's a catch. Even if a government doesn't have to repay its debt in the traditional sense, it still has to service it. That means paying interest, and that interest bill grows as the debt grows. So there is a limit to how much debt you can build up before that interest bill becomes a real burden. And if markets start to worry that a country's debt is spiraling out of control, things can unravel fast. So when does debt actually become a problem? Let's look at a famous and somewhat controversial study. In 2010, economists Carmen Reinhart and Kenneth Rogoff published a paper called Growth in a Time of Debt. They looked at over 200 years of data and concluded that once public debt rises above 90% of GDP, growth slows dramatically and sometimes even turned negative. It sounded like a tipping point, a cliff edge. But just a few years later, their findings were challenged. A paper by economists Herndon, Ash and Pollen found spreadsheet errors. When corrected, the cliff edge disappeared. High debt was still linked to slower growth, but it was found that the effect was smaller and more gradual. Reinhart and Rogoff admitted the errors and backed off the idea of a hard 90% threshold. But they still maintained, and it was widely accepted, that high debt slows growth, but on a more gradual basis. That makes sense. When we look at the Fiscal Sustainability Identity, it is clear that the level of debt only has a secondary effect. To show you why, I'm going to have to refer to one of those equations that economists love, with brackets and deltas and stuff. But feel free to ignore the equations and jargon and just focus on the takeaways. I think they are quite relatable. The Fiscal Sustainability Identity is a piece of macroeconomic accounting first formalized by economists at the World Bank and IMF in the 1960s and 70s. And since then, it has been widely used by other economists, credit rating agencies, and public finance officials. It's not a theory or a model, but rather an accounting identity, universally accepted and useful for assessing whether a government's debt dynamics are sustainable over time. It should be showing on your screen now, and what it is saying is that the change in the government debt to GDP ratio is driven by the determinants on the right-hand side. Those are the differential between the interest rate and the nominal economic growth rate, multiplied by the ratio of debt to GDP and minus the primary balance of day-to-day government spending. Deducting the balance means that we would add a deficit and subtract a surplus. So the first takeaway is that the government debt to GDP ratio will increase if the government is running a deficit. That isn't difficult to understand. It is the same for all of us. If any of us spend more than we earn, then the shortfall must be financed with debt. The second takeaway is also intuitive regarding the interest rate differential. Put simply, what it shows us is that if the interest on debt is higher than economic growth, then the debt will increase. And conversely, if the economy is growing faster than interest is accumulating, then debt will fall. The third takeaway is that the debt level by itself does not cause a change in the debt to GDP ratio. If the government is balancing its books and interest rates are in line with growth, then it doesn't matter if debt is 100% or 200%. However, the fourth takeaway shows us that operating with high levels of debt is nevertheless risky. If the interest rate stays persistently above the growth rate, then high debt levels become dangerous. The debt stock acts like a multiplier. A 150% debt to GDP ratio amplifies the interest growth gap by 1.5. A 200% ratio amplifies it by 2. This problem is made worse because there is a feedback loop. The existence of high debt levels will probably spook the market and raise interest rates, making the debt unsustainable. This means governments will find it very hard to maintain a high debt level and stability. It means that it is probably better to maintain a strong balance sheet so that the next recession, war, or pandemic can be dealt with, rather than causing a spike in rates that sends the country into a crisis. So let's return to the initial question. When does the national debt become a problem? Well, it's not a hard number or cliff edge like 90 or 120%. The crisis will happen when the markets start to get spooked. And when does that happen? Well, let's take an example. Let's look at the US. I would suggest that markets are already beginning to get spooked. Looking at US Treasury yields, we can see that after a long period of historically low interest rates, bond yields are starting to rise. After falling to around 1% after the Great Recession, the 10-year Treasury rate has risen to 4.5% and looks set to go higher. At the same time, the federal debt held by the public stands at about 97% of GDP. The last time it reached these levels was in the 1940s due to the expense and destruction of the Second World War. But today the US is at peace and the economy is close to full employment. Despite this, the US Congressional Budget Office projects a troubling fiscal path for the decades ahead. If current laws remain unchanged, the level of debt is expected to climb steadily, reaching 166% of GDP by 2054. In alternative scenarios, such as extending expiring tax cuts without offsetting savings, debt could rise even further, exceeding 200% of GDP. Now, I will be posting a video on the US economy in the near future, and we'll add a link at the end when available, so I'm not going to go into it too much here. Except to say that the projections are pretty conservative based on the current trajectory, an aging population and compulsory spending requirements. But when you look at what the US Congressional Budget Office is forecasting, you can see that the US is headed for trouble. Treasury yields are rising, real and nominal growth rates are falling, and the budget deficit is ballooning. Now, some people will point to Japan and say that its government has sustained far higher levels of debt for decades, at extremely low interest rates, without any major crisis. And that's true. But Japan is a unique case. Its government debt is overwhelmingly funded by domestic institutions and households, likely due to a mix of cultural, historical, and regulatory factors. Over 90% of Japanese government bonds are held domestically. For much of the past 30 years, Japan has been able to issue this debt at interest rates below inflation, meaning investors, especially households, have accepted negative real returns. In other words, they've quietly lost a large share of their purchasing power over time. Could the US government pull off something similar? In theory, maybe, but in practice, it's unlikely. The US relies far more on foreign investors and market-driven funding, and American households and institutions may not be so willing to absorb years of negative real returns without consequences. Okay, putting this all together, what do we have? Well, let's look again at the IMF and World Bank's Fiscal Sustainability Identity. We saw how the change in debt is driven by interest rates, growth rates, debt to GDP, and the primary balance. And we have seen from the Congressional Budget Office's forecasts that each of these determinants is heading rapidly in the wrong direction. Interest rates are rising, growth rates are falling, debt to GDP is soaring, and the primary deficit appears to be out of control. The CBO forecast for debt to GDP in 2054 is 166% under the baseline scenario. Feeding the numbers into the Fiscal Sustainability Identity, we can see that the States is just passing through this unprecedented level. We can expect the debt levels to continue to expand by 10% every year thereafter, and more if the market is in any way spooked by these levels. This is simply unsustainable and will have to be addressed by fiscal austerity. Markets have been patient, but interest rates are rising, and if the government won't correct course, bondholders will soon be forced to take matters into their own hands. A link for the next video should be showing now. Just click to keep watching. I hope you enjoyed this video. If you did, then please like, subscribe, and comment. Thanks for watching.